Advanced technical analysis, price action patterns. All right, let's begin with price action patterns. But before we dive into the actual patterns, let's first understand, what does price action mean? Price action simply refers to movement of a security's price that you and all other traders plot over time. You try to find out the price of a security and how it moves over a certain time period with the help of a few historically observed patterns, based on which you can formulate a strategy and take proper trading actions. You'll come across many short-term traders who will tell you that they rely on price actions and the formation and trends derived from them to make their trading choices. That's where technical analysis jumps in. You can consider technical analysis a subset of price action, which employs past prices of the security in calculations that you can use to make your trading decisions. You would have noticed how a security's price goes up and down over a period of time. You can use a variety of tools to apply to the chart that will help you determine the obvious trends in price action of the security. Technical analysis tools, much like moving averages, are calculated from price action and projected into the future to help you make better decisions. We'll cover all the important price action patterns that you, as a trader, should be aware of. So let's now dive into that without any further delay. Reversal chart patterns. We'll first talk about reversal patterns. Let's say that an underlying security is following a trend and moving to a certain direction, and once the chart pattern ends, that security will start moving to the opposite direction. Reversal patterns will inform you about when an existing trend will come to an end and starts moving in an opposite direction. They typically start by trying to continue the trend, but when the last-ditch attempt fails, the reversal is confirmed. However, you need to observe the market very carefully because more often than not, these reversal patterns fail, especially when the trend is strong. We'll be discussing 5 reversal chart patterns which are commonly used and will help you take better trading decisions. Head and shoulders. The first up on our list is called head and shoulders. This is fairly easy to observe as it resembles the human anatomy of our heads and our 2 shoulders. What exactly do we mean by that? Well, when you observe a chart pattern with 3 peaks, the first and third peaks are similar in height, just like our shoulders, and the middle peak is the highest, which is basically the head. When you connect the lower end of the first and third swing, it's called a neckline. And when the price of that security breaks the neckline, that confirms a change in trend. A head and shoulder pattern will help you determine the chart pattern formation, which will inform you if a trend reversal is in progress, be it bullish to bearish or bearish to bullish. The head and shoulders pattern is considered one of the most reliable trend reversal patterns, which informs you when an upward or a downward trend is nearing its end. Now remember, these 3 points that will help you determine a head and shoulders pattern. Number 1, following extended bullish trends, the price rises to a peak but falls subsequently to form a certain low. 2, from the initial low, the price rises again to form a new high, which is higher than the first peak, but then falls again. Number 3, the price rises for the 3rd time around to the level of the first peak, but then falls again, and this time breaking the neckline that we just talked about, hence confirming the change in the trend. Now, you can use the same logic of head and shoulders pattern to determine the reversal from bearish to bullish trend. An inverse or a reversal head and shoulder pattern gives you a signal when a downward trend is about to reverse and become an upward trend. The volume should increase on the breakout.